Okay, welcome to the run through of the weekly S&P 500 chart storm. So the purpose of this video is just to walk through a bit of a free flow through the charts from the latest tweet storm and to add a little bit of extra comments and context. A little bit about what I was thinking when I picked the chart and what it means. So first of all, here we've got number one here. First up, a check in on the Corona trades. And so that's got JETS, which is a global airline ETF, versus Cure, which is a China healthcare ETF there. So the ratio there you can see, obviously the China healthcare one has been doing pretty decently, with China A shares actually doing pretty good in the last few weeks, because looks like things are actually improving over there. Certainly some of the anecdotal evidence I'm hearing from there is that things are on the mend there. I mean, in terms of what kind of government is most well equipped to deal with a pandemic, China's government is pretty damn good for that kind of situation. Like it or not for the other things, but that's one good thing about that. And of course, airlines, anything, travel, tourism related has been smashed. So the other thing there is MGM, so they are a casino and hotel operator. And I've just got that displayed against the S&P 500 ETF there. So yeah, I just noticed they're worth keeping track of these from a virus market sentiment standpoint. We'll just blow that chart up there. And yeah, you can see the way that those ones have traded. The Jets versus Cure one kind of rolled over first, but they've both basically been trending down and then had that sort of climax into the back end of February. And yeah, I think these ones are pretty much a good kind of like a sentiment gauge for both the market sentiment aspect about the virus, but also the actual impact, because the way that these things usually happen is that you get this initial sell-off as the news emerges and gets put into the price, and that's kind of like the sentiment or price impact, and then eventually you get the actual impact, which may be as expected, or maybe worse, or maybe not as bad as expected, and based on the turn of that is how the price will evolve from there, and also how the opportunity set will evolve from there. So like, the way that these ones are traded is really quite interesting. So like, you look at that point 0.8 from 1.4 back then, it's almost half, and the same thing for that one, the MGM versus SPY, down looks like about 30% there. So it doesn't take much of a leap of faith to well, it doesn't take much of imagination rather to think about how those ones could trade coming out of this. But there's potentially a long way to go before we reach the other side. So I don't know. It would be interesting to track those ones, whether they just chop along, whether they get worse, or whether they do the old V-shaped recovery. I think everyone's kind of, well, I think most people that are paying attention have kind of dismissed the idea of a V-shaped recovery, just because it's something that's going to probably stick around for a while. But if we go on to the next chart here, so another one to watch is the complacency versus panic tides wash in and out. So we've got here Google search trends activity for coronavirus and stock market. Yeah, so this is going to be another interesting one to watch alongside that first one there. Just, you had, people started thinking about the virus there, and then as soon as the headlines started to worsen and it became obvious that it would become a global pandemic, then it started to factor into the market. But then interest of the stock market is starting to wane there. So, there's that initial panic versus ongoing impact kind of trade-off. Number 3 here is, and another interesting one, CDS of cruise liner stock RCL, Royal Caribbean, whose stock is down about 50% year to date. Yeah, so as I was mentioning before, there's a lot, or there's a set of sectors there that have been punished. As a side note, there's some sectors that have done well out of this. Like I saw there's one funeral home stock that had surged. That's a rather morbid observation. But also healthcare. I think anything medical equipment related, because there's going to be potentially some hefty one-off spike in demand for medical equipment, but then obviously also those that are working on vaccines, or anyone that has medicine that's actually relevant to this, would be good for them as well. But anyway, back onto this CDS here. So credit default swap, for those who are wondering. Basically this hits upon something that is kind of concerning, and that's if you have the impact of the virus. Like, if the virus sticks around for a long time, the pandemic issue, sticks around for months and months, there's going to be some companies like this who are right on the pointy end. Airlines, tourism companies, hotels, again, anything travel related, where people are just, no, they just cancel everything, don't book anything, don't take any chances. If those kind of companies have, high leverage, and, if they only have a couple of months of cash on hand to meet their obligations, then credit risk becomes an increasingly important and relevant thing, because, it could be that, you get this drop in revenue as a result of cancellations and no bookings, and then maybe a year later you get this rebound, or maybe a few months later you get a big rebound in bookings. It's probably fair to say that they don't come out flat, in terms of if you added up all the ups and downs. But even if they did come out flat, that kind of sequencing aspect has the possibility to cause quite a bit of damage. If you default, you might not actually be around to enjoy that rebound. So that's kind of like a side note. It's probably worth actually adding some of these to some of my own monitors, but so I might have to go and have a look at that. I do track some industry CDS, so I'll go and have a look and see what we've got going on there when I go and update my market chart pack for the market monitor. Anyway, number 4, S&P 500 50-day moving average breadth. So if you've been following this, the chart storm, you'll know that this was one of the original harbingers of the correction, because it was bearish breadth divergence there, higher high on price, lower high on the breadth indicator. It's now looking distinctly oversold. Of course, the usual caveat that oversold can get more oversold or stay oversold applies. But if we look at the chart here, it's usually this kind of action where it drops to an extremely low level relative to where it's been, and then bounces. Important kind of extra point there is when it bounces, it kind of get a stronger signal. If we just look at the recent history here, when you've had a big drop in this indicator to quote unquote oversold levels, oftentimes you get a bounce. I think it's relatively rare that you do get a V-shaped recovery where it just you have this big capitulation moment followed by a rapid rebound. In terms of the current environment, I guess let's play with that scenario for a second. How can you get a V-shaped recovery right now? Well, you'd have to get some probably overwhelming amount, or big bang, big bazooka kind of stimulus announcement, Fed rate cuts aren't going to do that. Um, some kind of new APP, asset purchase program, or quantitative easing thing would definitely have the potential to do that. How would that look? I mean, they could do a lot of things. There's a lot of different options they've got there. They could do a twist operation where maybe they sell short term and buy long term treasuries. They could do something with the MBS runoff, like stop the MBS runoff so that they remove a headwind from the mortgage-backed securities market, and therefore put more downward pressure on mortgage rates, and that would basically drive more direct transmission of monetary policy to the consumer. So that's quite an interesting one. They could do stock purchases, which I think the bar for that would be incredibly high. I think there'd be, you know, um, while it would be a good confidence kicker, you'd probably hear a bit of outrage from the CB crazies. And then, yeah, I mean, even just corporate bond purchases, like, um, European Central Bank and Bank of Japan have kind of laid down a lot of possibilities for where the Fed could go next, if it did choose to go down the balance sheet route. Um, yeah, I mean, there's a lot of possibilities there. I just wonder whether they would go down that path. You know, America is more of a capitalist society relative to Europe, which is more of a socialist society. So, I think Europe, you can get away with things that might look a little bit like nationalisation, buying up of private securities versus buying up of government securities. US, there might be, a bit more outrage about that, but we'll see. Anyway, so yeah, that's one scenario that you could get is some, bigger than expected kind of stimulus there, more on the fiscal front, more coordinated. Um, I think, on all of that, G20 is obviously on the wire saying that they might do a bit more, but I think you probably might actually have to see a bit more pain, a bit more down in markets, a bit more down in the data, a bit more worsening of the headlines before they actually get to a crisis point where they can actually justify taking more extraordinary measures. So that's one scenario. The other scenario where you could get a V-shaped recovery, going back to the start of this little diversion, or digression rather, uh, some sort of improvement in the virus headlines. So maybe some miracle vaccine gets invented. That would certainly drive a spike. Um, Something where the data becomes better than expected, or the virus counts fall. I mean, those things again, they're probably, I mean, or at least the latter part of that, that's probably something that's going to have to take weeks to evolve. So again, that actually takes the V-shaped recovery aspect off the table. So, you know, um, this chart here is probably not that helpful. If we go back to 2015-16, it's probably a better analog, or kind of model for how that might evolve. So yeah, well, this one's got a bit more history here. So number 5, surge in realized volatility, typically an indicator of a short-term bottom, and atypically an indicator of a once-in-a-lifetime financial crisis. So let's blow up the chart. So this is average daily range, just basically another measure of realized volatility, spiking there as you can see. And so previous spikes, let's have a look at them. We've got a short-term bounce there, another one there, bottoming of the correction there. Didn't work out too well at the top there. Another one where you had this rebound there. That one's quite an interesting one too, actually, is that, so we're looking at that one that was 2002, looks like it, late 2002. So you had this big slump there, and a little bit of a well, in a gradual recovery. Actually, that might be 2001. My bad. But anyway, yeah. Well, that one you had this, bit of a recovery and then back into the bear market. So, with these kind of indicators, it matters whether you're in a bear market rolling over process versus a ranging or uptrending market as to what happens next. If we look at those early 2010 ones, there you had a correction and a period where it just chopped and ranged. That's probably a good analog for the current situation. I mean, it's probably the best analog that I can think of actually, in terms of where my thinking's at. You get, this initial shock crash and then markets just range and chop for a while, kind of frustrating everyone. And then because of there's all this new stimulus coming online, eventually it gets back to bull, and then has a decent run thereafter, and even the subsequent one there is pretty similar kind of situation. 2015-16 is more of the W-shaped kind of correction. So if you think about three different correction kind of beasts or varieties, you've got the V-shaped one. I think it's pretty clear that we're not going to get a V-shaped out of this one, unless you do get some big bang stimulus. Then you've got the drop in range, which is very likely, and then you've got the W-shaped recovery, where you have a twin correction. You have this where it goes into a ranging mode, then recovers, and then goes back down, where you have like a second round impact, or so I think one thing to note about that one too is that you almost actually rolled into a bear market there, but what averted that going into a bear market was basically a whole bunch of stimulus. So again, that one's quite an interesting analog. Of course, the caveat with this chart is that it did spike into the financial crisis collapse, and in a bear market like in the early 2000s, it it only served to flag a short-term bottom. So yeah, and this is a short-term signal, so that's not surprising. Number 6, implied volatility, on the other hand, is in straight-up panic mode. Notably, the VIX futures curve indicator has bounced from oversold levels, so let's have a look at this. So the black line in the top panel there is the VXV to VIX ratio, so 3-month VIX to spot VIX, which is the futures curve indicator. When that one drops to very low levels and then rebounds, it's basically a short-term bottoming signal. And yeah, it went to panic mode and has pulled back from the brink. Meanwhile, the VIX itself has risen above 40, which is really definitely panic mode. Yeah, same kind of thing as the previous couple of charts, really. Market breadth, realized volatility, implied volatility, VIX futures curve, all pointing to oversold conditions, which raises the odds that you do see a bounce. But that going back to those those kind of different varieties of corrections, it could be that we get a bounce within a range. It can still range within the range can actually have a bit of space in it, where there is opportunities to be very tactical and just play that range, or it can be more grinding range. Number 7, sentiment check. So sentiment is close to maximum pessimism. So let's pull this up. So I'll just read this tweet here. I captured the whole tweet because I kind of felt that it captured the essence of this, and I didn't want to, just copy and paste the whole text. So sentiment trader here saying our SPY S&P 500 ETF optimisms index 10-day average is extremely low. Sentiment is close to maximum pessimism. The last 10 times optimism towards US equities was this extreme. SPY and the S&P 500 rallied 100% of the time over the next 2 months. So that would, potentially add weight to the idea that you could see an actual V-shaped recovery. Of course, it could be that you get a market that goes into a grinding range for a month or so and then goes back to business. So yeah, another interesting one to add to the mix there. The old fear and greed index is also in panic mode. You know, love it or hate it, there it is. Number 9, and my own one, it's a more slower moving one, called the euphoria meter, is looking distinctly less euphoric. So this one is made of 3 different things: the forward PE, bullish sentiment from surveys, which is a 12-month moving average there of the AAII and the II surveys, and the inverse of the VIX, which is moved on a 12-month rolling basis. So once those high readings start coming through, that'll start to push that down a bit more as well. If you got this going back down below 0, then that would help raise the conviction on the medium term versus these sort of short-term moves. And again, if we end up going into those kind of corrections where you do have a period of ranging before it gets back to business, then you'll have time for this indicator to come back down below 0, where it goes into kind of buying mode. So wait and watch on that one. And last but certainly not least, and we've almost already talked about this really, eventually markets will go back to what matters most, and that's liquidity. Liquidity beats headlines in the long term. So yeah, again, G20 on the wires on Friday saying that they are ready to take further action. Stimulus is coming. It's really just a matter of how big and how quickly it comes, and I guess also how much more pain needs to be borne before they take the steps to a more powerful mode. So let's look at the chart here. It's showing you in the blue line is it's a Bloomberg liquidity measure, or so Bloomberg's proxy for global money supply. But yeah, if you look at just about any other indicator, central banks have moved into stimulus mode again. Obviously the Fed, and then you've got a whole bunch of smaller ones that have been going as well, like Malaysia and I think it was Philippines as well, Moldova, a whole bunch of them. You're going to see a longer and longer list. I think Korea as well. But you're going to see a longer and longer list of central banks cutting rates. RBA again, also last week. But yeah, basically already talked about this. If you get more liquidity, more stimulus coming in, then that's going to speak louder than the headlines, or certainly once the headlines start to wane. I mean, China basically has provided us already with a case study for that. Again, as I mentioned before, China's started to get on top of their outbreak there, and yes, you can call it draconian measures. Yes, you can say, oh, but what about human rights? But in a situation like this, you basically need to just crack down and stop it from spreading, and that's exactly what they've done. And they've also done stimulus and monetary easing, and you can see that kind of coming through in their market already. So that could be a good analogue for how this plays out for the rest of global markets, certainly for US markets. It's but not to be too complacent or too dismissive. It probably will get worse before it gets better. And so yeah, let's be careful out there, and but let's not forget about what matters most.